What if I told you that the Federal Reserve, often shrouded in mystery, has a profound impact on nearly every aspect of your financial life? Imagine this: the decisions made by this central bank influence everything from the interest rates on your loans to the job market, and even the prices you pay at the store. In fact, did you know that the Federal Reserve has been pivotal in navigating the U.S. economy through major crises, including the 2008 financial meltdown and the recent pandemic? Yet, many people still don't fully grasp how this institution operates or why it matters. Welcome to Satoshi Finance, where we break down complex finance topics to educate and empower you on your journey to financial freedom. In this video, we'll dive deep into the Federal Reserve's role, unraveling its mechanisms, exploring its historical impact, and revealing why understanding it is crucial for anyone interested in the economy. Buckle up as we uncover the secrets behind the Federal Reserve and its influence on your daily life. The Federal Reserve, often referred to simply as the Fed, is the central banking system of the United States, established in 1913 with the signing of the Federal Reserve Act. Its primary purpose is to provide the country with a safe, flexible, and stable monetary and financial system. This institution was created in response to a series of financial panics that underscored the need for a central authority to manage monetary policy and stabilize the banking system. The Federal Reserve structure is designed to balance the interests of various regions and sectors of the economy. It consists of a board of governors, which oversees the overall direction and policy of the Fed, a Federal Open Market Committee, FOMC, responsible for setting monetary policy, and 12 regional Federal Reserve banks that serve different parts of the country. The Board of Governors, located in Washington, D.C., is composed of 7 members appointed by the President and confirmed by the Senate. The FOMC, including members from the board and the presidents of the regional banks, meets regularly to set key interest rates and guide monetary policy. Together, these components work to ensure that the Fed can effectively influence the economy, manage inflation, and promote employment. The Federal Reserve's primary objective is to manage monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates. This involves adjusting interest rates and influencing the money supply to control inflation and foster economic growth. By lowering interest rates, the Fed can stimulate borrowing and investment, which helps to increase employment and economic activity. Conversely, raising rates can help cool down an overheated economy and keep inflation in check. The Fed's dual mandate, to promote maximum employment and stable prices, guides its decisions on interest rates and other monetary policy tools to ensure balanced economic growth. In addition to monetary policy, the Federal Reserve plays a crucial role in maintaining financial stability. It supervises and regulates banks to ensure the safety and soundness of the financial system, aiming to prevent systemic crises that could destabilize the economy. This involves overseeing banking practices, managing liquidity, and acting as a lender of last resort during times of financial stress. Furthermore, the Fed is tasked with consumer protection, working to ensure fair practices in the financial markets and safeguarding consumers from abuses. This includes monitoring and enforcing regulations that promote transparency and fairness in financial transactions, thereby helping to protect consumers from fraudulent and unfair practices. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. The Federal Reserve implements monetary policy through several key tools, each designed to influence the economy's overall health. One of the primary tools is open market operations, which involve the buying and selling of government securities, such as treasury bills and bonds. By purchasing securities, the Fed injects money into the banking system, which lowers interest rates and encourages borrowing and investment. Conversely, selling securities pulls money out of the system, which can raise interest rates and slow down economic activity. These operations are conducted with the aim of achieving the Fed's targets for inflation and employment. Another crucial tool is the discount rate, which is the interest rate charged to commercial banks for short-term loans from the Federal Reserve. By adjusting this rate, the Fed influences the cost of borrowing for banks. A lower discount rate makes borrowing cheaper, which can lead to increased lending and economic activity. On the other hand, a higher discount rate can deter borrowing and help cool down an overheating economy. Additionally, the Fed sets reserve requirements, which are the amounts of funds that banks must hold in reserve and not lend out. Lowering reserve requirements allows banks to lend more, boosting economic activity, while higher reserve requirements limit lending to control inflation. Together, these tools help the Federal Reserve manage economic stability and growth. During economic crises, the Federal Reserve plays a crucial role in stabilizing the financial system and mitigating the impact on the broader economy. The response to the 2008 financial crisis is a prime example of the Fed's proactive measures. Faced with the collapse of major financial institutions and a severe recession, the Fed implemented a range of unconventional policies to restore stability. These included slashing the federal funds rate to near zero levels and launching large-scale asset purchase programs, known as quantitative easing, to inject liquidity into the financial system. The Fed also introduced emergency lending facilities to support troubled banks and markets, helping to restore confidence and facilitate recovery. In response to the COVID-19 pandemic, the Federal Reserve took similarly aggressive actions to address the economic fallout. The Fed quickly cut interest rates to near zero and expanded its asset purchase programs to support financial markets and economic activity. It also introduced new lending programs to provide credit to businesses, municipalities, and households affected by the pandemic. These measures were aimed at ensuring that the economy could continue functioning despite widespread disruptions. By acting swiftly and decisively, the Fed helped stabilize financial markets, support economic growth, and mitigate the recessionary impact of the pandemic, demonstrating its critical role in managing economic downturns and fostering recovery. The Federal Reserve, while central to the U.S. economy, often faces criticism and scrutiny from various quarters. Common criticisms include claims of lack of transparency and accountability, as the Fed's decisions and operations can sometimes seem opaque to the public. Critics argue that the Fed's policies can disproportionately benefit Wall Street over Main Street, particularly through measures like quantitative easing that may lead to asset bubbles and inequality. Additionally, some believe that the Fed's actions can lead to excessive government intervention in the economy, distorting market signals and potentially creating long-term economic imbalances. On the other hand, proponents of the Federal Reserve argue that its policies are essential for maintaining economic stability and preventing severe recessions. The Fed's ability to adjust interest rates and conduct open market operations allows it to respond flexibly to economic conditions, manage inflation, and support growth. Supporters contend that the Fed's independence and expertise are crucial for making difficult decisions that benefit the economy as a whole. Public perception plays a significant role in shaping the Fed's actions, as the institution often adjusts its policies and communication strategies in response to public and political pressure. The Fed's efforts to maintain transparency and explain its actions aim to build public trust and ensure that its policies are understood and supported by the broader community. In recent years, the Federal Reserve has faced a range of new challenges and opportunities as the financial landscape evolves. One of the most significant developments is the rise of digital currencies and the potential for central bank digital currencies, CBDCs. The Fed is actively exploring how digital currencies could impact monetary policy and financial stability. As private cryptocurrencies gain prominence, the Fed is considering how to ensure that digital currency innovations do not undermine the stability of the financial system. Additionally, financial markets are becoming increasingly complex, with the rise of fintech, new investment products, and global economic interdependencies creating both opportunities and risks that the Fed must navigate. Looking ahead, the Federal Reserve is focusing on several key goals and potential reforms to address these emerging challenges. One area of focus is enhancing financial regulation to address risks associated with new technologies and market practices. The Fed is also examining how to better integrate economic research and data analytics into its policymaking process to respond more effectively to economic trends. Potential reforms may include adjustments to the Fed's framework for conducting monetary policy, with greater emphasis on inclusivity and the impacts of policy on different segments of the population. As the financial environment continues to evolve, the Fed will need to adapt its strategies to maintain economic stability and ensure that its policies remain effective in a rapidly changing world. In summary, the Federal Reserve plays a pivotal role in shaping the U.S. economy through its management of monetary policy, financial stability, and consumer protection. By influencing interest rates, controlling inflation, and overseeing the banking system, the Fed helps steer the economy through various phases of growth and downturn. Its actions during significant crises, such as the 2008 financial meltdown and the COVID-19 pandemic, highlight its critical function in mitigating economic disruptions and supporting recovery. Understanding how the Fed operates and the impact of its decisions can provide valuable insights into the broader economic landscape and how it affects everyday life. Grasping the intricacies of the Federal Reserve is essential for anyone interested in economics, finance, or simply understanding the forces that drive economic conditions. With the Fed's influence on everything from inflation to job markets, staying informed about its role can help viewers make better financial decisions and engage more meaningfully with economic discussions. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.